So, the new Income Tax Act 2025 is on the horizon, and that means things are changing. And for every single one of us, tax pros, business owners, the big question is always the same, right? What income is actually taxable in India? Well, the entire answer to that starts with one absolutely crucial provision, Section 5. It's what defines the whole scope of total income. Let's break it down.
All right, so here's how we're going to break it all down. We'll kick things off with a common scenario you've probably seen 100 times. Then, we'll decode the rule itself. After that, we'll see how it all works in practice, talk about some critical compliance points, and wrap it all up with a simple toolkit to make sure these key concepts stick. Ready? Let's jump in. You know, to really get a feel for why Section 5 is so important, let's not start with the dry legal text. Let's start with a real-world problem that a lot of professionals are dealing with right now.
This is such a classic cross-border situation. The client's in another country, the money lands in a foreign bank account. I mean, it feels like it shouldn't be Indian income, doesn't it? But here's the thing. The answer has nothing to do with where the money lands. It's all about the rules baked into Section 5.
Okay, so come April 1st, 2026, the new Income Tax Act kicks in, and it's a bit of a game changer. Before we can even begin to think about things like deductions or tax rates, we have to know what income is even on the table to begin with, and that is the job of Section 5. Think of it as the ultimate gatekeeper that decides if income is even within the scope of Indian taxation.
Okay, so let's actually look at the legal text. Now, it might look a little dense at first, but this short paragraph is the entire engine for how a resident's income gets taxed. And I want you to pay close attention to that tiny word, or. That's a tiny word with huge power. It means the tax authorities don't need to prove all of these conditions. Just one is enough to pull that income right into the tax net.
All right, I know that legal language can be a bit much, but trust me, we can break it down into three really simple, powerful ideas. We'll call them the 3 pillars of income. And this table here lays it all out for us, nice and clean. For any resident, there are 3 separate gateways for income to become taxable here in India: receipt, accrual, and the global scope. Remember, and this is key, you only need to pass through one of these gateways for that income to get captured. Okay, this next point is probably the most critical distinction you need to master: the difference between receipt and accrual. Think of it like this. Receipt is about geography. It's the physical spot where you first get your hands on the money. Accrual, on the other hand, is about your right to that money. It's usually where you did the work or provided the service that earned you that right. Now, the Act has this really interesting tool in its back pocket. It's called deemed income. Basically, it's a legal fiction. The law can just decide, or deem, that an income was received or accrued in India, even if in reality it wasn't. For instance, a salary you earn for services you provided in India is deemed to accrue in India, even if your employer pays you in a bank account overseas. It's a really crucial anti-avoidance tool.
All right, but there's a really important exception to that third pillar, the one about global income. This is a special rule, and it only applies to a specific status, the not ordinarily resident, or NOR. For an NOR, their foreign source income is generally off the hook, unless it comes from a business that's controlled from India or from a profession that was set up here. That's a critical nuance to remember.
Okay, so now that we've got the rules down, let's circle all the way back to our consultant at the beginning. We can finally solve this puzzle using our 3-pillar framework.
Let's walk through this step by step. It's actually pretty simple. 1. Is she a resident? Yes. 2. Where did the income accrue? Well, she did the work from India, so that's where her right to the money was established. It accrued in India. Now, it doesn't matter one bit that it was received in the U.S. See? That condition under Section 511B is checked. It's a done deal. That income is taxable in India. It really is that straightforward.
So, knowing the rule is half the battle, right? But applying it correctly and consistently, that's the other half. So this next part is all about the practical stuff, compliance, and how to avoid some really common mistakes.
So here are your do's, your compliance checklist. First things first, always get that residential status right for the tax year. That's job number 1. Next, keep meticulous records for any foreign income. Third, if you're a resident and ordinarily resident, an ROR, you absolutely have to disclose your global income. No exceptions. And last, and this is a big one, understand the difference between the first point of receipt and just moving money around later, which is remittance. The law sees them as 2 totally different things. And now for the don'ts, the common pitfalls you really want to watch out for. The number 1 trap is what I call the foreign account myth. This idea that if money is received abroad, it's somehow invisible to Indian tax law.
We just proved that's totally false. Also, please don't ignore those deeming provisions. Be super careful with the NOR test. And like we just said, don't confuse remitting money with receiving income. These aren't small mistakes. They can be really costly.
All right, to bring it all home, let's boil everything we've covered down into a simple, memorable toolkit you can take with you.
Look, if you walk away from this explainer remembering just one thing, let it be the number 3. Section 5 is built on those 3 core pillars: receipt, accrual, and global income. That's it.
So let's recap the big takeaways. First, residential status is everything. It's the starting point for the whole analysis. Second, for most residents, the tax net has a global reach. Third, remember the OR rule. It's powerful. Income is taxable if it's either received or accrued in India. You only need one. And finally, for our NOR friends, it's all about the source. Is that foreign income tied to a business or profession that's being controlled from India?
And there you have it. That's your deep dive into Section 5. We really hope this explainer helps clear up the whole idea of the scope of total income. If you found it helpful, do us a favor and share it with your colleagues. And of course, follow us for more breakdowns of the new Tax Act.
This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.